All right, let me share something with you. After spending nearly 8 decades in the world of investing, I've come to understand a truth that most people simply don't want to hear. The most effective investments are painfully dull. I mean so dull that when I start explaining them, I can almost watch people mentally drift away. They're waiting for a secret formula, some complex maneuver meant only for insiders or billionaires. But the reality is this: the investments that have earned me the most money are the ones I barely pay attention to, the kind you set up once and then leave alone. Some people hear that and think lazy is an insult. They believe investing should be intense, hands-on, and exciting. But I've always believed the opposite. If your investments are giving you thrills, chances are you're doing something wrong. The objective isn't excitement. The objective is to stay ahead of inflation, protect your purchasing power, and grow your wealth steadily over time without driving yourself crazy. And there are investments that do exactly that. They're straightforward, dependable, and demand very little from you. That's what I want to talk about today. 5 investments almost anyone can make. You don't need exceptional intelligence. You don't need a lot of money. And you certainly don't need to sit in front of financial news all day. You just need to understand these investments and then have the discipline to leave them alone, which, frankly, is the hardest part. Buying them is easy. Not touching them afterward is the real challenge. Let's go through them. First, and arguably the most important, are low-cost index funds. I've been talking about these for decades, and people still hesitate. They say it's too basic, too uninteresting. But simple works. An index fund gives you ownership in a small slice of every company within a specific index, like the S&P 500, which represents the 500 largest companies in the United States. When you invest in an S&P 500 index fund, you immediately become a partial owner of Apple, Microsoft, Amazon, Berkshire Hathaway, and many others. And here's the beauty of it: you don't need to choose winners, pore over financial statements, or guess the right time to buy or sell. You're simply investing in the country itself. And over time, America grows. Companies innovate, productivity improves, profits rise, and your investment grows alongside them. Historically, the S&P 500 has produced average annual returns of about 10%. Some years are better, some worse, but over long periods it averages out to roughly that. With inflation typically around 3% per year, your real return comes out to about 7%. That means your purchasing power roughly doubles every decade, and all you have to do is hold on. I always tell people to steer clear of high-fee index funds. Choose one from Vanguard, Fidelity, or Schwab with expenses around 0.3% or 0.4% annually. Every dollar lost to fees is a dollar that can't compound for you, and over 30 or 40 years those costs become enormous. Back in 2007, I even made a $1 million bet that a basic S&P 500 index fund would outperform a group of hedge funds over 10 years. These hedge funds had elite managers, supposedly the brightest minds on Wall Street, charging 2% annually plus 20% of profits. The result wasn't even close. The index fund earned about 7.1% per year, while the hedge fund struggled along at around 2.2%. That's the strength of low costs and broad diversification. You don't need brilliance. You need sensible laziness. If you remember just one thing from this entire discussion, let it be this: invest in a low-cost S&P 500 index fund and leave it alone for 30 years. That's the strategy. Boring. Completely. Effective. Absolutely. The second investment often surprises people: Treasury inflation, protected securities, or TIS. It doesn't sound exciting. Government bonds rarely do. But listen closely. Traditional bonds have a major weakness. When inflation rises, the fixed interest payments lose purchasing power. TIPS are built specifically to solve that problem. The principal you invest adjusts upward with inflation each year. If inflation is 3%, your principal increases by 3%. The interest you earn is calculated on that adjusted amount, meaning you are guaranteed to keep up with inflation. You won't get rich quickly with TIPS, and that's not their purpose. Their role is protection, stability, and confidence that your money will retain its value no matter what inflation does. Every portfolio needs some of that balance. Stocks drive growth, but you also need safe assets for difficult periods. TIPS fit that role perfectly, and they're wonderfully hands-off. You buy them, hold them until maturity, and you're done. Inflation and interest rate changes are handled automatically. Yes, you can experience short-term losses if you sell before maturity, especially when rates change. But if you hold to maturity, you're guaranteed your principal plus inflation adjustments. That kind of certainty is invaluable, especially as you approach retirement. The third investment is one I'm particularly fond of: dividend aristocrats. A dividend aristocrat is a company that has raised its dividend every year for at least 25 consecutive years. Think about what that means. They've survived recessions, crashes, and crises, yet still increased payouts to shareholders. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, and 3M fall into this category. These businesses have strong competitive advantages, solid balance sheets, and dependable earnings. What I love about dividend-paying companies is that dividends enforce discipline. When a company commits to paying shareholders regularly, it can't waste cash recklessly. And if it wants to keep increasing dividends year after year, the business must grow and generate real cash flow. As an investor, you benefit twice. You receive income from dividends, which you can reinvest or spend, and you participate in the company's growth. Dividend stocks may not soar as fast as flashy tech names, but they also don't collapse as dramatically. They're steady, predictable, and over long periods they often outperform the market. Numerous studies have shown that dividend-paying stocks outperform non-dividend payers, largely because dividends compound. Reinvest those payments, buy more shares, generate more dividends, and repeat. It's a snowball effect. All you need to do is resist spending the income and let it reinvest automatically. Decades later, the results can be astonishing. Fourth, and especially important for younger investors, are real estate investment trusts or REITs. I've said before that your personal residence usually isn't a great investment, and I still believe that, but income-producing real estate is a different matter. The challenge is that most people don't have the capital or expertise to buy apartment complexes or commercial properties. REITs solve that problem. A REIT is a company that owns and manages real estate, and by law it must distribute at least 90% of its taxable income as dividends. That means regular income for you and exposure to real estate, which generally keeps up with inflation as rents rise. Not all REITs are equal. I prefer those that own assets people rely on regardless of the economy: hospitals, cell towers, data centers, self-storage facilities. You can buy REITs in a standard brokerage account just like stocks. No tenants, no maintenance calls, no late-night emergencies. You simply own shares and receive dividends. REITs can be volatile in the short term, especially when interest rates rise, but over the long run, high-quality REITs tend to perform well. They also diversify your portfolio since real estate doesn't always move in sync with stocks. Again, it's a lazy investment. Buy it, reinvest the income, and move on. The fifth investment might be the most overlooked yourself. It doesn't sound like an investment. It sounds like effort. But when you're young, your greatest asset isn't money in the bank. It's your earning power over the next several decades. Investing in your skills pays returns for life. If you earn $50,000 a year and improve your skills enough to raise that by just 10%, that's an extra $5,000 every year. Over 30 years, that's $150,000 before investing a single dollar. And no one can take that away from you. I've often said the best investment I ever made was a Dale Carnegie public speaking course. It cost me $100 back in the 1950s, and it changed my life. It improved my confidence, communication, and relationships. The return on that investment was incalculable. This investment does require effort up front, but once you acquire valuable skills, they compound just like money. Skilled labor becomes more valuable over time, especially in a growing economy. Read, learn, take courses, seek mentors, and aim to be excellent at what you do. When you step back, all 5 of these investments share a common trait. They beat inflation over time. They generate returns without constant attention, and they benefit from compounding. Compounding is one of the most powerful forces in finance. Albert Einstein supposedly called it the 8th wonder of the world, and for good reason. Invest $1 out at 10%, and after 1 years, 2 years, 2 on 10, after years 2,594, after 20 years 6,727, after 30 years 17,449, same money, same return. Time makes the difference. Lazy investing works because it doesn't interrupt compounding. No panic selling, no market timing, no unnecessary taxes. Just steady growth. The real secret is patience. People understand these ideas but abandon them because they're boring. A neighbor mentions a stock that doubled in months, and suddenly discipline disappears. Chasing excitement almost always leads to losses. The more thrilling investing feels, the closer it is to gambling. Real investing is dull, and that's why it works. For every person who got lucky, dozens lost money. Don't confuse luck with skill. I recently spoke with a 25-year-old who had saved $10,000. I told them to put $8,000 on an SP 500 index fund, $1,000 in a right, and keep $1,000 for emergencies. They were disappointed. That was the whole plan. And yes, that was it. Add to it regularly and come back decades later at 10% annual growth of the $10,000 becomes $4.52 in 40 years. Add 200 a month and it grows to over 1.3 million. All from being boring. The real enemy of lazy investing isn't the market, it's your emotions. Fear and greed ruin more portfolios than recessions ever will. Markets will crash and soar. The lazy strategy only works if you stick with it. Hold when markets fall. Hold when they rise. Don't panic. Don't chase. Just hold. You don't need to beat the market. Matching it puts you ahead of most investors because most people underperform by trading too much and paying too many fees. Ordinary investing is extraordinary precisely because so few people stick with it. Inflation scares people, but these investments are built to handle it. Stocks raise prices. TIPS adjust automatically. Dividends grow. Rents increase. Skills gain value. Cash, on the other hand, loses purchasing power every year. If your money sits idle, inflation erodes it. Put it to work and let it grow. That's really it. 5 lazy investments that beat inflation index funds, TIPS, dividend aristocrats, REITs, and yourself. Simple, boring, effective. I've seen every market cycle imaginable, and the winners aren't the smartest or most active. They're patient, disciplined, and consistent. Wealth is built slowly, quietly, and steadily. Do the boring things long enough, and one day you realize you're wealthy. That's the whole game. Start now, no matter your age. Choose boring, choose lazy, because boring works. Thank you for listening.